My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job's not just to entertain, but educate and teach you. So call me 1-800-743-CNBC or tweet me, Jim Cramer. Sometimes we get a piece of research that I like so much that I got to share it with you on air. Today, with the market wavering, Dow dipping 63 points, S&P shedding 0.2%, NASDAQ losing 0.59%, I found a strategist report from Bank of America's Savita Subramanian titled U.S. Equity Strategy Year Ahead, 5 Reasons for S&P 500 at 5,000. And I got to tell you, I like this piece very much. At this time of year, you begin to get a lot of reflective pieces musing about what could happen next year. When I saw a piece coming out with a 5,000 price target for the S&P 500, up nearly 500 points from here, it caught my attention because almost no one seems willing to be publicly bullish at the moment. Now, some of that's simply because it's so easy to be negative. I know from firsthand experience that if you're bearish and you get it wrong, nobody blames you. Really, ever since the dot-com collapse more than 20 years ago, it's never paid to stick your neck out and recommend stocks. I keep doing it anyway because maybe I'm a glutton for punishment. But make no mistake, the bulls are punished. You'll be ridiculed as a hopeless pumpkin. And beyond public scrutiny, it's much easier to lose your job on Wall Street actually by being too positive. If you're bullish on something and implodes, that can be a fireable offense. In the end, being cautious and wrong is a lot safer than being bullish and wrong. Right now, in particular, you seem like a rube for liking stocks. I mean, don't you know that there are 2 war zones? Don't you know that just the interest on the national debt will shackle your grandchildren and make you want to live in New Zealand or at least Singapore? Our president just turned 81. That birthday cake looked like it was firebombed. And the guy who's likely running against him might have to conduct his campaign from a courtroom or worse. Doesn't exactly make for an optimistic backdrop, does it? All of which is to say that this bullish piece from Bank of America showed some gumption, something that's in short supply in the research community and non-existent among media commentators, at least for stocks outside the Magnificent Seven, including NVIDIA, which reported tonight and gave you its fantastic outlook, but has gone up so much that there's always people who want to find things wrong. Subramanian's thesis is that we have a stock picker's paradise coming. I like that because it says we might get away from the gangster's paradise of the 10-year tyranny. Remember, for most of this year, we cared about long rates, the rates set by the bond market, and how they relate to short rates, the ones set by the Federal Reserve. While long rates kept going higher as the Fed increased the short rates, we had a market where virtually all stocks seemed to trade together. Every stock was just a member of an orchestra conducted by, indeed, yes, the long end of the bond market. Once that ended with long rates peaking just a few weeks ago, we caught a fantastic upward wave in the market with some truly breathtaking moves in individual stocks. Hence what Subramanian is saying about a stock picker's market.
House of pleasure.
Just think about the last few weeks in retail. We've seen tremendous rallies at Home Depot, Target, Macy's, and today Burlington. Largely because they were underestimated and the actual numbers weren't horrible. You had to get 3 things right to successfully pick these stocks. First, you needed to know the zeitgeist, what Wall Street was looking for from these stores. Second, you needed some reason to believe the true results would be better than the estimates. And third, and maybe most important, you had to figure out what Wall Street would pay for that differential. You had to get a lot of things right, but if you got it right, you made beaucoup dinero. Mix a few metaphors there. The piece is arguing the last few weeks could be the new normal. Then Subramanian gives us the 5 salient points about why the S&P 500 could go to 5,000. What I'd like to do is walk you through them because the piece articulated them so well, I want to give it its due. First, she talks about how there are too many skunks at the garden party. It's an odd way of saying that there are a lot of bears who don't seem to have much conviction, meaning they're negative, but maybe they want to morph into bulls if they get a chance. That's always what happens at the end of a big decline. Second, she says we have a Goldilocks economy, not too hot, not too cold. So kind of ideal. She expects wage gains to be offset by bigger productivity and higher margins. I'm not really buying this one, though. I think what's happening is that we don't have much inflation, and we might have less in the future, and that will cause the Fed to not raise rates. Now, unlike Subramanian, I think the maximum amount of money will be made between when the Fed stops hiking and when, if ever, in 2024, it actually starts cutting rates. I don't see Goldilocks. I just see okay growth with declining inflation. But you know what? That is good enough to get us to 5,000. Third, she believes that corporate profits can accelerate even if GDP growth slows. Now, I think that's partially true because so much of the S&P 500 these days is not related to the broader economy. But even if she's right, I think you'll have to avoid the industrials and many of the more cyclical tech stocks if she's right. Fact of life, Not everything goes up at once. I disagree with that on that one, too. Fourth, she likes what happens in election year, including bipartisan defense spending and also fiscal austerity that could hurt health care. Sorry, I'm not buying this one either, at least not this time. There's no consensus on anything out of Washington, not even defense. There's nothing but partisan rancor and a total inability to get things done. But as we know, nothing getting done from Washington is actually good news for the stock market, which loves gridlock. Nevertheless, I'm not counting on anything good from Washington this election year, or at least nothing good for the stock market. When you have a president who walks the picket line against Ford, bolstering the UAW's Sean Fain, the most radical union leader since Walter Reuther died in a suspicious plane crash, that doesn't make for higher stock prices. The Democrats are the party of labor, not capital, which means they don't care as much about the stock market. Meanwhile, the Republicans are out of power. And when you're out of power, you don't lift a finger to make life easier for the incumbent. So I don't see either party doing much to bolster stocks. Finally, there's this fifth pillar. It's a catch-all topic of U.S. advantages, including deglobalization, energy security, the dollar's reserve currency, and wealth transfer from my fellow boomers to our kids, $80 billion or $80 trillion. Now, look, none of that is wrong, especially the $80 trillion that I got to give to my kids. Well, not me, $80 trillion. I'm not one of those guys. I'm not a Magnificent Seven guy. But I don't think these have a lot of octane. So I can pull this research apart and find fault, as I just did. Or, you know what? I can just say most people are pretty convinced that nothing good can happen from here, unless we're talking about the Magnificent Seven. I think next year might be about the other 493 stocks besides the seven, especially if the FTC stops being so aggressive about blocking mergers, because mergers would be the lifeblood of the next bull market. The bottom line, let me close out by saying that, broadly speaking, I actually agree with Savita Subramanian at Bank of America that we could go to 5,000 the S&P. But other than sentiment being way too negative, I'm non-committal about what could get us there, at least for now. Let's go to Steve in California. Steve.
Jim, how are you?
I am good, Steve.
I watched you this morning, and you looked so happy, and you sounded so happy because of the Eagles' win last night. But anyway.
Steve, sometimes I wish you shouldn't let something you can't control make you so happy. You really shouldn't. But they make me very happy, and they made my father very happy, and I guess that's just what happens in America.
Well,
how can I help?
It came across this morning. So anyway, my question, Jim, is about AI technology. Obviously, a very topical subject these days.
Right.
So, you got me in NVIDIA back, a couple years ago.
We've liked it for a long time.
Well, we have, and I know that, and you got me in it along with my due diligence. But that's historical, okay? It's had a great run. We know about OpenAI. OpenAI basically right now has a market cap of around $86 billion. Who is the next player on the horizon for another home run like this? Do you have any ideas?
Look, it is something I think about constantly. Who is going to be the next player? And I have to tell you, all I can do is come up with betters, like a Cadence, like an ARM. I don't have the next NVIDIA, but I would also tell you one thing that I do, Steve, that other people criticize, but I say, who needs another NVIDIA when we have an NVIDIA? Wayne in California, Wayne.
Booyah, Jim!
Holy cow, Wayne, how you been?
Hey, Jim, I have to say this. Jim, I love watching you, loving what you do.
Thank you. Thank you.
It's special
Thank you very
to
much.
see that.
Yeah, I'm kind of fired up.
So,
I mean, the only thing is the vacations really rankle me. Just putting it out there. My wife doesn't watch. She doesn't have to worry about that. I mean, but really, what do? You sit around? What do you play Wordle? I mean, Joe, thank heavens for some football games, right? I mean, other than that, I mean, what's the point? I mean, it's like, if they paid you for vacation, that'd be, like paid you double, like overtime for vacation, because that's what it's like, overtime. Go ahead.
You don't have to work, and you love doing so much of what you do, and that's inspirational. Thank you so much.
But the bosses, if they were watching, I don't. I need every penny. I'm desperate. Okay, now we're good. Now we're good.
You're the boss.
How do you get that in there,
Jim, $31 average cost. I have close to 16,000 shares. What would you do with Uber?
Oh, Uber is a buy. There, I think I've made myself clear. Hey, well, you know what? Let's go to Texas. Just kidding. Let's go to Austin in Pennsylvania. Austin.
Big booyah, chill, man. How about our birds last night?
The Birds look so good. You know, I'm just going back and forth with my friend, buddy, pal, Howie Roseman. What a team he's put together. Hurts is just look, I can't say enough. I am unfortunately on a business show, though, so we got to do some work.
So I'm having a bit of FOMO on this recent IPO. I'm looking at ARM Holdings within a P around 115, and NVIDIA's P is around 120. I want in on ARM, but I'm worried this price is a bit too high right now.
It is a little too high. Now, we did nail this when we said if it went below 50, you got to buy it. I think that Renee Haas is doing an amazing job. I am not going to say you'll be wrong if you buy it here. I am saying that if next year at this time, we may not even know the difference. I think it's going to be higher. I think that they are a super company, and you've got a winner. All right, broadly speaking, I agree that we could go to 5,000 the SP. But other than sentiment being way too negative, I'm a little non-committal about what gets us there. Oh, man, tonight, HP reported after the bell. So what can investors glean from the report when it comes to the state of PCs and printing? I've got the exclusive with the CEO. Then could an investment in Tyson leave investors with egg on their face or rule the roost? I'm taking a deep dive into the story and give you my take. And looking to play the trucking sector, I'm going to see if this Alfred Schneider, you've seen their trucks on the road, could be the way to invest in the cohort with the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.